Hello, everybody. My name is Andrew Dix, and I am the founder of the Crowded Media Group. We're the publishers of Crowdfund Insider. And thank you for joining us today. We are hosting a webinar on the real estate market and online investing in real estate or real estate crowdfunding. And we're very fortunate to have with us here four experts in the real estate market. And we have representatives from Ground Floor, Small Change, Dalmore Group, and S22A Modular. And we're going to start by asking each of you to introduce yourself and explain exactly what you do. We're going to start with you, Dean, because you're showing up there on my left.
You got it. Okay, my name is Dean Delisle. I'm the Chief Revenue Officer at S2A Modular, and I oversee all the capital raise as well as the multiple market demand throughout the country and some international locations now. So I have a unique lens where I work with over 60,000 registered builders and developers. We're very data driven, so I really get a unique lens on trends and certain markets and what's hot, what's not, and those adjustments that unfortunately we all have to make to accommodate those markets. So happy to be here today, and thank you for having me on.
Yeah, thank you very much, Dean. Let's go to Etan.
Etan Butler, chairman at Dalmore Group. We are a FINRA broker-dealer headquartered in New York, founded in 2005. We have onboarded over 1,000 companies to date, including over 300 Regulation A clients. Large majority of them over the years have been in real estate, both in Reg D, Reg A, and great to be here with all these esteemed guests and with you, my friend, Andrew.
Yeah, it's great to see you again. Always love having you. Awesome. We're going to jump over to Eve. Eve from Pittsburgh.
Sure. My name is Eve Picker. I'm the CEO and founder of smallchange.co, which is a crowdfunding platform. And one of the things we do is we raise money actually, we are the first real estate crowdfunding platform that used regulation crowdfunding as one of its offering tools. So under regulation crowdfunding, anyone who's 18 can invest in real estate deals on our site. And I'm sorry, did you hear that? Did you hear that? I'm a little distracted, sorry. So anyone who's 18 and over can invest on our site. And the projects that we list are projects that we think are going to somehow transform cities. And that can mean either the developers are minority or women developers, or they're working in disinvested neighborhoods, or they're working on projects that really need to be invented. For example, new forms of affordable housing. So that's what we're focused on. Thank you.
Awesome. Thank you very much, Eve. Brian, last but not least.
Yes. I'm Brian Daly, co-founder and CEO of Ground Floor. My co-founder, Nick Bargava, actually worked on Title III of the Jobs Act, which became Regulation CF. And the reason we met is we shared a vision about how capital markets could be disrupted by those rules. We thought that retail investors participating would be a very important part of that a lot of the private market offerings, in particular in real estate, the sorts of things that Eve does, or the sorts of things that you'll find through Dalmore's clients, and certainly on Ground Floor, have a necessary and important place in people's portfolios if our objective is to build wealth for the masses. In 2015, we were qualified for the first time, so that's about 8 years ago, by the SEC to offer non-accredited investors and accredited investors alike the opportunity to participate fractionally in high-yield short-term real estate loans. We have financed over $1 billion in investments. That's retail investments. That's not institutional capital showing up to make the numbers look big. Those are retail investors, just like people who may be in the audience, participating $10 at a time in our fractionalized offerings. We've delivered returns of over 10%, historically, whether the housing market's up or down. And that's because with Ground Floor, you get to be the bank. So I'm looking forward to the discussion. I think there's a lot of vibrant opportunity out there for the retail investor today. And I think real estate is a great place to be. So thanks for having me.
Yeah, awesome. Thank you for being here. So I think that, first of all, I want to give a shout out to both Brian and Eve, because I consider you guys OGs, because the two of you, I think we're pretty much here or trying to be here from the beginning, at least how I remember that. I'm starting to get old. Maybe my memory is failing me, but you guys are OGs. Been working at this for a long time, so kudos for that. In regards to real estate crowdfunding, I think that when the Jobs Act was created, that the policymakers weren't really thinking about real estate. They were thinking more about early stage. But I think that online capital formation, securities crowdfunding really works quite well for the real estate industry. It's created a unique market with opportunity for smaller investors. And I think it's going to be one of the big winners over time, especially with the advent of Reg CF, Reg A+, as well as Reg D 506C. So let's start looking at today. There's been a lot of news in the past weeks about the struggling economy. We've got rising interest rates. We've got work from home, which has changed the makeup of many urban markets. We have recently, it was about a week or two ago, there were two large hotels in San Francisco where the owners simply said, hey guys, we're done. Here are the keys. Gave them to the banks, who's ever providing the debt to finance those things, which in my mind is kind of scary. Just last week, FSOC had on their agenda the commercial real estate market, because they're a little bit worried about it. And so I wanted to start the conversation to specifically talk about commercial real estate, because each of you are experts. You each have a unique vantage point in what you see and from where. And I want to hear what you're seeing today. And so I guess we're going to start with you, Dean. We'll start with you, Dean. We'll go to my left up here. What are your thoughts on commercial real estate? And we're going to get to residential in a second, so let's really focus on commercial. Is it time to panic?
No. And each market cycle, and we could probably have a whole different webcast on this, is has opportunistic findings, I'd say. So what's interesting for us, I mentioned I raise capital both for my own developments as well as for S2A's building of factories. And what's interesting is over the course of the last couple of years, call it post-COVID, right, if you will, we saw a shift out of the heavy metro areas. We're here in Chicago, saw people running for the suburbs, et cetera. And we started to see a change, not in our demand, but the type of demand we were getting requested. Now, keep in mind, I'm speaking from our factories can only build up to 5 stories. So we're not building skyscrapers. But what we did have a heavy demand and still do are for schools, medical office buildings, retail, which I'm continuously surprised how much pop up, banks. And it's funny that you mentioned about the hotels, because I'm still amazed at how many hotel requests we get for orders inside the factory. So I think not necessarily the product type has changed in terms of commercial, but maybe the size, people have gone smaller. And I think location, it's interesting to see now where people are putting those projects. And I think that has a lot to do with, you mentioned, how many people are working from home versus, maybe commuting in 1 or 2 days a month or a week or whatever that looks like. And I don't know if we'll ever change from that. If it is, I think it's a clean decade out, but people are getting comfortable in running their companies that way and doing business that way. But we'll always go to meet the customer, right? So the customers for banking, retail, and we're in a convenient society. So things with drive-through and easy accessibility for DoorDash folks and things like that are don't seem to be going away. They continuously popping up. A lot of Dollar Generals, those things are modular. They pop up everywhere in the world. So I say retail, yeah, mixed use, medical, offices, and schools. That's what I see. So
it's kind of targeted from your vantage point. So I think that so you mentioned the work from home, which I think is a big catalyst here. Recently, Elon Musk, he did an interview. He said, well, it's not fair. We've got to go back to the office. I think that there's going to be, some in office, but I think depending on the industry, you just can't put that genie back in the bottle. It's you can increase productivity, your lifestyle changes. I think we are seeing an adjustment that's not going to go back to where it was, 9 to 5, 7 days a week, going to Madison Avenue to work in an office someplace. I think it's changed. Of course, I could be wrong. It does happen. Eve, tell me.
Right. So I want to disagree a little bit with Dean. I think I don't see people running to the hills. I think, it depends where you live. I live in downtown, and what I've noticed over the last couple of years is an explosion of co-working spaces. So what does work from home mean? It means a little bit more flexibility, being able to move around, but people seem to really want to be able to congregate in groups in smaller office spaces, which we call co-working. Co-working is also changing. I think basically, maybe it's not a time to panic, but maybe it's a time to be more creative. And real estate has traditionally moved very, very slowly, kind of like a dinosaur. I mean, if I think about, housing that people build, it's for a family unit that barely exists anymore. So, maybe it's time to reach.
A different metaphor there. Dinosaurs are extinct.
I know, but you know what I'm saying, right?
Yeah,
Plodding, slow moving, partly because of permitting and other requirements, but still, I think it's just time to redefine what office means, and I think it does have a place, and there is definitely a desire for it. It's just different. But I also think there's some fallout that is going to continue. If you think about very large floor plate leases expiring, I wonder what's going to happen when they end, because I think many more businesses are not going to renew in the same way that they used to. So I think there's a shift going on that was accelerated by the pandemic, but was already happening.
So you mentioned, I think you mentioned specific markets. Correct me if I'm wrong. The same as Dean did. Is it depends on the market, and you're coming from a mid market in Pittsburgh, so it sounds like you're pretty bullish about Pittsburgh when you're talking to shared workspace, right?
Well, there's been an explosion of companies that have stayed here because they can't lure away CMU graduates. So Google has offices here, Facebook has offices here. It's a great place to have a business, and it's a great place to hire talent. And that talent wants to be close to those spaces. Our co-working space, which I'm sitting in, is a block from the Google headquarters. And so every day we get people asking us, do you have space for groups of 4 to 6 people, 8 to 10 people, one person? I mean, there's definitely demand. It's just very different demand. So much harder to rent a large space than a small space. That's my experience. I have a second building in this market, which is almost like an old schoolhouse, and I wish I had 5 of them. Those little rooms, 400 square feet, just rent so quickly, it makes your head spin. People want to be out of their homes, but they don't want to invest in a space that they're not sure their business will grow into, if that makes sense.
Yeah, they don't necessarily need. There's no sense in renting open, unoccupied offices. That doesn't make sense. I think you made a point there that you said things are going to change, and I totally agree with that. That people are looking for something different than just a cube and white walls. And I think that's just part of the equation going forward. Brian, so you're mainly in residential. I know that. We're going to come back to that. But you're also based in the South. You're based in Atlanta. So you bring another perspective because we just had the two Northerners kind of share their spin. What is your point of view? What are you seeing in CRE?
Well, first of all, as you can tell from listening to these guys who are practitioners in the area, CRE is not a monolith. So there are many different subcategories within CRE. And within that, your mileage will vary. I think if you're looking for consistent themes, certainly what I hear my friends in that industry talking about, what we see developers in Atlanta doing, is investing in quality locations, quality amenities. If you're talking about office, in Midtown Atlanta is unrecognizable, not only from a couple decades ago, which would be obvious, but even since we moved the company there in 2014. And I think what I have great respect for is, people who in environments like this where, cap rates aren't as low as they were, certainly, but interest rates, hurdle rates are a lot higher. Capital is harder to come by. Refinancing is harder to do. We have our eye on the value added space, especially we especially like lending in those places. A bit of trivia and history: back in 2013, the first building that we thought we would try to finance with ground floor was actually a mixed use commercial space. And ultimately we found our way to the residential market, and that worked better for our long-term strategic objectives. But we've always kept an eye on that market because there's a lot of opportunity there. There's a lot of opportunity wherever you have aging stock, wherever consumer tastes are changing and are dynamic, and especially in a place like Atlanta, where, it's a Sunbelt market and the demographics are in your favor. There's a lot of vibrancy in Midtown and pockets outside of Midtown, around the perimeter of the city, a place like Alpharetta, for example. There's just a lot of, there's a new urbanism that I think doesn't go away just because people are working from home. And actually, there are new forms of urbanism that are going to emerge because people are working from home. And I think part of what Eve was saying is aligned with that. So we're watching the space. We're interested about it. I think we've been fortunate to have made that turn into residential. It's been a great place to be, and I think will be for quite some time to come. But we have broader interests as well.
That's interesting. I kind of like how you describe that. It's a new form of urbanism, and I think that kind of captures my opinion. Again, I don't know if I'm right or not, but I think that makes a lot of sense to me. Etan, it's time for you to jump in. I think you're mainly Northeast, New York metropolitan market, but you're also spent some time in South Florida. Correct me if I'm wrong. What's your point of view on commercial real estate?
I think we're coming off a number of years with historic rise in value and opportunity in the CRE space. And I think we're at a beginning of a cycle that's going to create great opportunity for investors. I think that cheap capital created inflated pricing. We've seen this before. Like everything else in life, the commercial real estate sector goes in cycles. And when it's easy to borrow money and banks are flowing, the more people enter the space, valuations go up. And naturally, it reaches a point where it needs to reset, which is healthy. And some people are caught, above their skis currently, and are in a lot of pain. And so what's going on behind the scenes are issuers that are concerned, and that's going to create some deals that are going to be made available. And I think what the differentiator today is that the other 90% this year could participate in what historically has presented itself in the past, similar situations, 2007, 8, whatever it may be. It was the same group of kind of vulture investors. Here you have innovative issuers who are taking advantage of Reg A, Reg D, Reg CF, and they're going to be making some of those investment opportunities available to the everyday person to take advantage of this cycle of opportunity. So I think having cash on the sideline is a good thing. And I think the more patient you are, the better the opportunities are going to be over the upcoming months.
Yeah, that's cool. And Eve, you'll love that. For the last decade, all of my organizations have been home in a co-working space, and we're investors in.
There you go.
But But all those leases, those expensive leases that we had in Chicago and New York and San Francisco are long gone. So
Yes, yeah.
So it sounds, I mean, all of you seem to be pretty bullish, which is encouraging. So, you know, times of distress can create opportunities, what I'm hearing. And maybe what we're seeing is specific markets that have other catalysts that are impacting valuations and, you know, people flow and all that. But it sounds to me like, Brian, your whole new form of urbanism, that makes a lot of sense to me, and I think you know, it creates an opportunity for people to take advantage of that, platforms to take advantage of it, and investors to take advantage of that. So I think that's very interesting and encouraging. So let's jump over to residential. This is a very different market, in my opinion. I'm not an expert like you guys, because people need to live someplace, you know, mostly, and so we're talking about single family dwellings. We're also talking about, you know, multifamily. I think sometimes it's slotted into commercial, but let's talk about residential markets. And I'm going to start with you, Brian, because, you know, this is wheelhouse for you. I mean, this is really what you guys have really focused on. You shared with us earlier that for your historic returns have been a little over 10%. And I believe that's net. Again, correct me if I'm wrong, which is, it's pretty good, especially, you know, when we were in a low interest rate environment. And now we're in a higher interest rate environment, but there's a lot of risk out there. So you are the residential guru. What does Ground Floor see today?
Well, we've received a couple questions here in the chat too that kind of get to the point that I want to make on this and answer your question. The reason we ended up in residential, and we make business purpose loans, so it's not an equity investment, it's a business purpose loan to real estate investors or entrepreneurs who are going to acquire and then redevelop a property that's aging housing stock. One of the reasons we selected that category, there are a few driving factors. One, it's a really short term. So in this housing market, that's been a great thing for us to be making sort of 12-month loans, because we're not making a bet on rate or leverage or market that has to go out many years. We just have to look a year ahead. And you can look on our blog and see how conservative we've been about house prices over time. And we continue that conservatism because we don't really care. I mean, we're cheering for our customer, right? We're cheering for the entrepreneur to make a lot of money on the upside of the project. But as lenders, as people who are fractionalizing the debt part of the capital stack, we just want to make sure that there's enough profit for the operator to make money, and then enough margin on the project, you know, to make sure that the loan gets repaid with full interest. The second reason we chose this is it's very high yield, right? We are now writing loans that are about 12.5% coupons on average. That's very attractive in this market.
6 to 12 months.
What's that?
He's like 6 to 12 months.
6 to 12 months, and you earn a 12.5% rate. Now, why? You have to ask yourself, man, that's a lot higher than a bank. Why would anybody borrow money at that rate? Well, the true alternative, in fact, 2 out of every 3 house flipping projects or new construction projects that are financed this way outside of banks, they're financed with equity capital, which means that at the end, the operator who did all the work, did all the sweat equity, has to then split their profits. So in a business in which these investors are typically making 40-45% return on equity, there's plenty of room for them to pay all of us a 10 or 12% yield. The third reason that we selected this as the category, and why I continue to love this category, is it's extremely profitable for those users, which means they can feed the platform. We are a profitable company. Our core line of business is incredibly profitable. And that gives us enough money to go invest in all kinds of new products and in software experiences and try to advance the state of the art, which we choose to do. Like we've chosen to make those investments in the business. But fundamentally, you know, we make enough money per loan that we can finance a lot of software development, a lot of marketing, a lot of growth. We've grown the company to a $24 million revenue top line over the last 10 years. And the reason that we're successful economically as an enterprise is because this category is lucrative. The reason it's great for the long term is because people need a place to live. There's a supply-demand imbalance. There's always going to be demand in the segments that we serve, which are kind of the low end of these, low to middle of these kind of Sunbelt markets. And, one of the problems that we care a lot about is housing supply. Well, if you want housing supply, you have to redevelop aging housing stock. There's only so much land, to be developed in the places where people want to be. And so we think our customers are doing important work. One of the most exciting changes that we've seen is the people who are running for the hills are the institutional investors, the iBuyers, the Wall Street firms. They're out of here, man. And it's not because there aren't good deals to be had, but it's because they've had their hat handed to them in a lot of these markets. And they've realized it's a local business that should be driven by the kind of independent entrepreneurs who Eve and I finance on our platforms. And we're cheering for those guys. And I think this is a great market to be in it. We've shown that this category as a lender, at least, can weather these storms, these ups and downs in housing prices. And we continue to see evidence that there's more of the same to come. So a little bit of a history lesson, a little bit of an answer to some of the questions that have been popped into the chat. I hope that's helpful.
Yeah, no, I mean, that's great perspective. And I find it really interesting. And I find the product that you're offering very interesting too. So the other day I was, you see some of these like red hot markets, Florida, Texas, and slowing markets like a Cali. But I saw something the other day where it said Miami, which has been like really hot, seems to be slowing down a little bit. Is that what you're seeing? Are you seeing that in Atlanta? Is this just, a pause for the, continuation of a bull run? Or maybe it's just kind of, getting things back into balance because interest rates are so high? I mean, what's that dynamic there? Can you explain that?
The main dynamic is rates, right? So in a high rate environment, we're going through a period of rate normalization. Whether you think 5, 6, 7%, 8% mortgages are high or not depends on how old you are and how much perspective you have on the market. So eventually, once we see how sticky these higher rates are, and a lot of commentators think they're going to be sticky and high for a long time, people tend to normalize. They adjust their expectations about how much house with how high end of finishes, they actually need and that they want to afford with their salary. And what we're seeing is transactions are clearing at a higher rate despite mortgage rates, continuing to tick up. And that's because people do need to trade. They do need a house. In a lot of cases, they may not want to be a renter. We can debate whether that's a good reason or a bad decision in different markets and different places for different people, financially speaking. But for quality of life reasons, a lot of times people do want to own a property. That's their perspective. And I don't think that's going to go away. 62% of Americans own a house at any given time, and I don't think that's going to change appreciably. It tends to tick up and down by 2, 3, 4% decade to decade. But no, I think those frothy markets. Yeah, I mean, look, if you owned property in a Colorado mountain town, as my wife and I have for many years, we were astounded at the price appreciation. And in those situations, it's flattened, but it actually hasn't declined a lot. It's kind of interesting. I mean, these are houses trading like meme stocks. In other markets, if you're at the high end, and you had a really big run up in HPA, house price appreciation, that is going to regress to the mean. That can be painful for some people who maybe were overextended to be in that. But for the most part, our borrowers just aren't in those places, and they're not in those segments. They tend to be in the more liquid, sort of more stable kind of house price segments that didn't have a huge run up and aren't having a huge comeuppance. It looks pretty stable, which for our business, we think is great. And for an investor, we think that's something to be seeking out too.
It's good. Eve, I want to jump over to you because you do mostly residential multifamily stuff. And yes, you are a Pittsburgh champion and you're based there, but you also operate around the country, at least from what I've seen on your website.
Right.
What are you seeing in the residential market today?
What do I see or what do I think? Two different things. So
it's what you see.
What I'm seeing. Okay, what I'm seeing, and I really know much more about the multifamily market. So it's a little different than what Brian was talking about. In multifamily, I am seeing a lot of developers sitting on the sidelines and waiting. The cost of building, coupled with interest rates, has made it unfeasible to really move forward. Experienced developers I know who build, let's say, for example, workforce housing, say that even if they got the land free, they couldn't finish a project. It's very difficult time. And then we had the bank runs earlier this year, which means that small banks are being even more cautious about lending. It is very difficult to borrow money right now. This is what I'm hearing from developers everywhere. And most of them are just waiting. And some of them who I know well are saying, well, we're just going to tread water for 3 years and not do anything, which is a long time, especially because we need housing, right? We need housing. It is, I mean, how many millions of houses do we need? We don't have enough in the country, not nearly enough. And we need affordable housing, and interest rates and the increase in materials and goods and the cost of building have made it even harder to build affordable housing. That's certainly truly affordable housing is not something an investor will ever get a return on, because that's the point. You want to keep it affordable, and you can't do that if people are getting a 12% return. So it's a catch-22. It's a very difficult time. I'm also seeing lots of attempts at manufactured and alternative housing. Most of them have not really accomplished affordability yet, but I'm hopeful that we will get there. I mean, there've been all sorts of different things, pods and tiny houses. And let's face it, if you look at a market like Japan, their approach to affordability is basically a 100 square foot apartment, which is in our market not something that would ever fly. So I think we have a huge problem. I think we have a really big problem. And as prices go up in the single housing markets, that of course drives up prices everywhere, which means it's less affordable. So that's what I see.
So to distill this a little bit, you have a supply issue and a rate issue, and it's creating this two-sided vice that is just,
And I don't know that it's going to resolve itself easily, because I really don't think that construction prices are going to go down. I just don't believe they'll go down. I know that people say, well, I'm just going to wait for prices to go down and regulate themselves. And I'm thinking, why? Why will they? How will that ever happen? Now, interest rates will go down sometime, but prices won't go down. So you have a mathematical equation here. What must go in must come out. If it costs you this much to build a building or house, and it costs you that much in interest until you sell it, then you have to recoup that, or you'll be in the hole. And you hope to recoup that with a little bit of profit.
Right. Yeah. So also what I'm reading, and sorry to interrupt you there, is that so many people are locked into these 2.25% interest rates that they're hesitant to sell. And there's always people who need housing or need to move. And so there's very little inventory. Building a house or an apartment building takes a long time. We all know that we've had supply chain disruptions, on top of, a pandemic. Actually, I was reading the other day from Redfin that the total number of U.S. homes for sale dropped 6% from a year earlier during the 4 weeks ending June 11th, the biggest decline in 13 months. New listings dropped 23%, continuing a 10-month streak of double-digit declines. Those add to the deepening post-pandemic inventory shortage. There are 39% fewer homes for sale now than there were 5 years ago in June 2018. So, yeah, we've got a supply and demand imbalance.
Right.
I want to give Etan a chance to jump in here. You see it from multiple issues, Etan. What do you think about the residential real estate market?
First, we have a number of really interesting, innovative issuers that focus on, the single family home industry, not necessarily from the industry, but, from like, let's say, developing prefab homes at scale. And so all kinds of, unique things that touch on single family homes, but more direct, what we're seeing is fractionalization. Now, we could speculate which way, how long. I think these are all great points about, cost of goods needs to go down, along with interest rates participating to kind of create this to better the situation. We don't know how long it's going to take, and what other factors might be at play before they do resolve themselves. Where it's a really volatile time globally, environmentally. So I think you kind of, it's hard to, we're seeing a lot of first evers, that, at least from our generation's perspective, of the plague, and all these things are really wild. So you got to kind of be thoughtful about that. You can't fully ever figure everything out. But one thing that's really interesting is that issuers are now fractionalizing shares in real estate, in single family homes specifically. And so they're breaking a home down into $10 shares, and they're allowing people to buy those shares, including someone who otherwise couldn't afford the house could buy a percentage of those shares with the right to buy the rest. All kinds of really innovative things that aren't just to get certain celebrity investors super wealthy on the backs of making single family homes more expensive. And I understand that concern, that perspective, but there's also really thoughtful innovators that are utilizing Regulation A to fractionalize and offer renters an opportunity to become owners in a compliant way. That's super interesting, right? And regardless of what direction the market goes, what I know for sure is that now more investors, the other 90%, are more easily able to participate in more of these opportunities. So that's really what we're seeing, an explosion of issuers, many in the real estate space, whether it's past a flow through of rental revenues from vacation homes, or whether it's equity participation in the upside of certain communities. Really interesting. And I think we're going to see a lot more of that.
So we're out of balance now, but it looks like the markets are adjusting. It's just going to take some time. We know that. Dean, once again, you bring an interesting perspective with what you do. Residential, where do you see us today?
So I'm going to speak from two positions. So I also am a developer, and I develop resort communities and 55 plus communities, and then specialty communities for youth. And what's interesting from that side of the fence is in the last 2 years, especially post COVID, and then the interest rates starting to creep up. We just started to shift our developments now, not so much the size for us, because we're developing resorts. So think of like RV parks and cottage homes, country homes, and then executive homes. We didn't shift that much at all. But what's interesting is we shifted the type of buy-in, so people can buy in and become renters in that RV community, in that other smaller home community, and we're giving them options to do that. And to Etan's point, we're even looking at some of the developments as potential co-ops, not necessarily fractionalizing it, but going back to the days of co-ops where the retail delivery stores that are in that community, especially for the youth, the millennials, the Gen Xers and whatnot, they like to belong or have a part of something. So if they can come in and not necessarily own, but build to rent, but also be part of a co-op, they get the best of both worlds. So we're starting to see a lot of those pop up. And what's fascinating to me is that now on the S2A side, we're getting inundated with tiny homes. And it's just blowing me away that the number of people that will, they're in a nice area. They want to plop 10 tiny homes on an acre of land and Airbnb those things. And I don't know how long that market has to live. I mean, myself, I'm not building out that way, but the demand that's coming in for tiny homes is way far exceeded what we projected.
So tiny homes is within a certain square footage.
Think of it under 800 square feet. So,
okay.
and
I own a tiny home then.
I
600
used to have
square
a
feet.
I used to have a tiny condo.
Yeah.
But no, I get you.
I
And
think
so-
what's interesting, I think what's interesting about that is that you're pointing out how capital can change the landscape and
Yes.
change how we think, how it can influence affordability. A lot of times when people think of capital, they think of Wall Street coming in and rolling in and messing everything up. And
Right.
that's not untrue, right? That we do see that. But I think when one of the great virtues of building a capital market this way is it plays to the strength of the independents, and the independents think differently. And I think this is a product development problem. Tiny
I
homes are
agree.
part of that. It's a
and-
product
Yeah.
development problem. It's about rehabilitating aging housing stock in a way that allows people to stay in their neighborhoods without
Right.
pushing them out, without bulldozing, blocks of property. It's about going house to house and community to community. And a lot of the people who we fund live in these communities
Right.
where they're investing, and they care about the quality of the community and what's happening. And I think I think in general, we had a theory when we started the company that yes, this would be a great retail investment product, and we think it is. Part B that we're now testing in our next 10 years is what does this change in capital markets and where the money's coming from to do these things? What does that bring as an opportunity to change the world? And that's where I get excited about my work on a whole different level as an entrepreneur. And I'm sure you guys feel the same way, where the source of capital, where it comes from and how it's formatted, it matters. It matters to real people, real communities. And if we're going to solve this product development problem, it's going to be the people who we finance as retail investors, millions of nodes on a capital network, not the typical Wall Street suspects who come in and out of markets, like they're just trading in and out of, the stock of the day. This is not a commodity, this is a community. And that's what I think I think that's the bigger project that we're all engaged in here from a capital market.
Well, and to your point,
So let me ask you first, hey Dean, how much is like the standard vanilla modular home that you guys? What is the price point of that?
well, it ranges anywhere from 140 a square foot to 390 a square foot if you're building, depends on what you're building, right? Because we're a lot of sustainability, renewable energy. We build with hemp materials. It's specialized product. But what I want to tap into with what Brian was talking about is here's what's interesting. So, we did our first raise for S2A to build the factories that build the products that we're talking about. And we have about 350 investors that have contributed 70 million on that first round. So that round's closed out. And now we have another round. And this is all Reg D stuff where they can come in and we were going straight institutional, but I said, wait a minute, we were built on the foundation that the regular person could take their 401k IRA and have a shot at investing in renewable energy, smart tech building, right? So this green building initiative. Well, what's interesting about that is the people, when we lowered it to 50,000 and we created a 1,000 slots for retail, all those people flooding in are those people, Brian, like you said, that are living in, regular USA places. And they just, want a ADU in their backyard, or they want a spot to have, they want to be part of building a tiny home community, but their attachment is interesting that they come in and they just have a passion for that side of the fence, in terms of being part of building out a community or building out a community like there's somewhere else. And now they have a connection to that style of building. And that's why it's great what everybody's doing here, because it's giving every person out there that ability to, whether they're playing in the fix and flip space, the multifamily space, the small home space, to a way to attach and be part of that building or rebuilding, depending on where they're at. And that's important.
Yeah, I think there's some overlap here too, because I think that the modular concept is really interesting. It's still it's not really young because Sears used to do it, but I think it's kind of has a resurgence today. But I also think when you look at the construction today, more and more of that's being modular. You send your specs off to a company and they build the framing, and it all shows up on your truck. And so I think that's kind of overlapping here. But I do think that it's interesting from both perspectives here, that there's opportunity there. And so I want to keep moving here because I don't have as much time as I want to talk about these things.
But I need to say something, and that is, I think we're losing track of the power of crowdfunding here, because when you innovate in housing, when you build a boxable or a tiny home or something else in any place, and you go to the bank for a loan, they need and want to run an appraisal. And if there are not three like-kind buildings, they won't lend you money, which means that innovation dies on the vine. Okay, it's not possible to build unless someone's already built it, which is an insane thing to talk about, right? That's not really releasing innovation. So crowdfunding, I think, is a huge opportunity to experiment and finance things that banks or traditional financial institutions will not finance. And I think that is truly the power of it. And in addition, crowdfunding provides an opportunity for groups of people, classes of people, Blacks, minorities, women who are not part of this real estate industry, and therefore releases an additional workforce into the real estate industry.
No,
Well, and I think it's our job too to continue to educate people of how to do those things. You know, whether it's crowdfunding or financial resources and capabilities to. I mean, we have finance companies that specialize. We have 3 banks that specialize in modular, and they do one-time closes because technically it's construction, but because and again, I'm only 3 years old in this side of the business, but I got rid of all my traditional stick building because I could see a home being built in a factory in a week and a one-time construction loan being converted to perm within 20 days. I've never seen that in any construction loan that I've been part of over my years. So there's a changing landscape and there's an appetite. But what's interesting, as we said earlier, the big Wall Street guys are not behind it, but the private lenders are way behind it. And most of the banks are just hanging on for their dear life right now. So they're not accepting it. But there is a lot of money and there is a lot of change out there that's available.
There is. Banks are risk adverse. And today more so after we've seen several like stumble and fail. And so I kind of get that. And you make a valid point there, Eve, that, you know, broadening your capital structure to a wider market creates opportunity for both sides. Because you're right, Dean. I mean, Wall Street rolls hot when they see big money in their eyes, and a lot of it goes to them, and maybe they slice a few pieces off for their investors, their smaller investors, but they're looking for the big bucks there. So I want to shift topics here right now. I'm Andrew. I have a little bit of money in the sideline. I've been a little bit concerned about, you know, investing in certain markets, and I think real estate's an interesting opportunity. I'm going to ask you, Brian, so granted, this is not investing advice. This is just hypothetical here because I know you guys don't want to give investing advice. But I come to you and I say, I have this money today. Say I have 10 grand today. What should I do with it, Brian? I'm talking to you, the expert. Where do I put my money to generate the best risk-adjusted return over the next 12 months?
Look, I think it's a very personal question, right? And I think what's exciting is that there are now more interesting ways to answer that than ever before. You can stick it in a savings account or a money market fund and earn, 4 or 5%, which is not nothing, And for some people who have need of liquidity, and need to know that that money's there and can be tapped, that is probably the most appropriate thing to do with that $10,000. Now, if that $10,000 at the opposite end of the spectrum is, money that you just want to maximize your return and you don't necessarily need it for a long time, and you also are willing to expose it to a risk of loss, then you can invest in something like, equity in a real estate project, right? Which can sometimes be speculative and isn't always speculative. It's less speculative than some other alternatives that you might consider, like trading cards or NFTs or something, because at least there's a real, business and a real object underneath it. Now, I will
No.
say at ground floor, when we look at that specific scenario and somebody comes to us and is looking for options for their capital, we want to be able to serve the full range of that over time, with real estate investing. So our traditional product is kind of right there in the middle. It's a 1-year loan. You can build, because the minimum investment is $10, you can build a portfolio of these things. And if you compare what that portfolio will do to a REIT, it returns your capital back. Once you're in steady state, it's returning about 1/10 of your capital back every month. And if you compare that to what a REIT generates, it's 10 to 12 times as much as a REIT will pay you on a dividend basis, just in
I'm not a
pure
big fan of
raw
publicly
cash.
traded REITs. It's just an
Well,
expensive.
the problem with publicly and privately, traded REITs, even the biggest, most important, most successful REIT on the planet, even they won't give you your money back if you want to trade your shares in Blackstone's REIT. The data shows that they could only handle 17% of redemption requests in Q1. And if that's true for Blackstone, just imagine what it is for every other, smaller, less liquid, less well endowed, sort of REIT that's out there. We think that model is dying because you can be your own REIT on platforms like ours and across the web. So we're trying to build a suite of products that take that $10,000 and give you, help you make your own choice between how long you're willing to lock that money up and how much liquidity you need from it on what terms. If you come to our platform, you can invest in a 1-year note that will pay you 7 or 8%, and it's backed by a pool of real estate loans that we've originated. Now that's less than the 12% you might make investing in loans that you pick and choose on the platform, but you can go anywhere in between on that. And I think that's healthy for people to have choice.
Right.
A lot of us haven't really had that kind of choice. We don't have private wealth managers, who bring us special off-market deals all the time. And I think that's a great thing for people and for society. So that's how I would answer the question. I'd say it's very personal, and there are a range of options, and you want to be thinking about how long your money's tied up and how much risk you're able to bear on those different dimensions.
Okay, I'm going to keep this moving. Dean, should I be investing in Airbnb properties? I've got $10,000. What would your thoughts be if I wanted to get into real estate? What should I do today?
Well, I would say I like and again, it depends on the appetite, right? So I'd love for everybody to invest in S2A modular, but it's not for everybody, right? Because we're building the product that we're all talking about. But in terms of the projects that we look at, and then we watch our investors that invest in us, and some of them go to Eton's platform, and some of them go Brian's way, et cetera. They, what's interesting is I think it depends how much money you have and how much you're willing to leave that money in the game, right? And I can't stress enough that whatever you're investing in, you need to really educate yourself like anything else. You need to, watch a ton of YouTube videos, et cetera. But if you're talking about smaller dollars or less dollars, like let's call it anywhere from $5,000 to $50,000, I think fractional is the way to go. Fractional, especially if it's in a BTR, a build to rent type scenario where it's a rental unit, there's rental income, there's appreciation value in that marketplace, and you can publicly see migration of people going to that market, I think has tremendous benefit.
All right.
Yeah, and again, there's a lot of other opportunities out there, but I would say on those dollars, 50K and under, that would be a good bet.
Eton, do you agree with Dean?
I agree with both Brian and Dean actually on the points that they brought up. Look, put it in the bank and collect 5%, and just take a deep breath first of all, and pay off debt, and then that's already a very strong place to be in relative to what was available years ago. That was what REITs were, and so you gotta take that pretty seriously until you are inclined. But it really comes down to suitability, right? If you're young and you can take some risk, then you're going to be more inclined for equity. If this portion of your capital that you want, less risk perhaps, then it's more yield-based offerings. And so it really does depend in that regard. But I do think that what we're going to see in the next number of months and year are going to be tremendous opportunity to capitalize on some of the equity opportunities that are available in the real estate space. I think there's going to be a lot of people in pain, looking for an exit or a reorganization or bankruptcy, and I think that save some of your money for in case it might happen. It's what I'm thinking personally.
I like that. Yeah, there you go. There's some insight. Eve, I'm coming to you. I have, I'm a small investor. Do you have any? Should I put my money in a money market?
Sure. Well, all I can say is what I would do with it. This is my investment thesis. And if I could, I would invest all of it in projects on small change, but I'm not permitted. So I can't, but you might be able to. So my thesis is, I would invest maybe in 5 to 10 projects. I'd invest in cities and in anything that makes them better. I would invest in edge neighborhoods. I like long-term investments that take a long time to pay you back because they will make a difference. I'd invest in Black emerging developers and in women developers. And fundamentally, I would always and do always invest in places I know and love and in people I believe in.
I think that's a solid point. Yeah, for those of us who can remember the last financial crisis where you had Deutsche Bank buying homes in Cleveland, Ohio. What did they do with them when they failed, when the loans went bad? I kind of like that. Local, invest local. That's kind of cool. So we're going to jump to questions here in a second, but before we do that, I want to go around the room and I want every one of you here to look into your crystal ball and tell me, what do you anticipate for 2023 and 2024? I kind of think that, I'm a little bit optimistic. I kind of think that they're going to be cutting interest rates at the end of this year. I know there's a lot of people that disagree with that, but I'm going to go to the real estate experts right now. And I'm going to start with Brian. What are your predictions for the rest of 2023 and 2024?
Well, I think rates are going to remain higher than people want for longer than you want. And I predict normalization of that. I think we will entrepreneurs will figure out how to do what entrepreneurs do, which is to make progress no matter what the weather is. I think next year we see a case for moderate house price appreciation, in rental, for example. I think the big risk to rental right now that I think people aren't really handicapping adequately is the impact of recession. If we do slip into recession, and if I could tell you whether to expect that, I guess I should be running a hedge fund or something. So I don't know whether we're going to tip into recession, but we very well may. Now, you look at some of we live in a global economy. I think one underappreciated factor is, China and the liquidity that they're unleashing on the globe now. That probably will give us the soft landing that the Fed has been looking for. If I had to make a bet, that's what the bet I would make, but I'm not in that business. So I don't make those bets. I just think that there will be assets that, like I think Bitcoin as an asset is going to do really well in this environment. Something that, where inflation is persistent and liquidity is high. I think something like gold and other commodities. I don't actually think house prices are going to trade like meme stocks anymore. I just don't think that's there. I think we're going to regress to the mean in house prices. I'm very happy with that, even though, we are offering slices of equity, fractionalized equity. And one reason we're doing that is exactly what Eitan was saying, which is there are awesome opportunities to provide liquidity to people who need it. But we think the opportunity in single family residential is actually not where people, have seen opportunity over the last decade, rentals. We actually think the big opportunity is in value added development. And, that's where liquidity is truly lacking, like Eve was talking about. Supplying that liquidity can be very lucrative. And I think it's going to be rewarded because we're going to have very stable, exit prices for housing for a long time to come. That's not true everywhere. Somebody's going to pick a market and say, "Oh, this was down." Absolutely, it's local. You have to be smart about where you are and how overheated it is. But our outlook is pretty stable and normalizing for the next 12 to 18 months.
Okay, awesome. So I'm gonna keep this moving. Eve, your crystal ball, what do you anticipate for the rest of the year in 2024?
So I'm not going to talk about assets. I'm going to talk about investors. And I think that cities are getting wise and that they see that they can insist that developers provide real estate investment opportunity to the communities they build in. And we're seeing this pop up in many different places. Developers are being forced to think about giving minorities an opportunity to invest. So this is the shift that I want to follow, that we want to follow at Small Change. And we see that as our biggest opportunity. We're positioned to step in and help make this happen.
Okay, all right, fair enough. Dean, what do you anticipate for the next 12 to 18 months?
And now for something completely different. I'm a big proponent of anything to do with tech, sustainability, and wellness. And the reason I say that is I've been studying it pretty much in depth since probably about 3.5 years when I got involved with S2A. But what I see, and just having a construction company, I deal with this is, Eve mentioned early on about cost control. So whatever economic climate we're in, there's a big factor of cost control. So that's why I'm a new fan of modular, but anytime we can help control some of the supply chain, or we can adopt innovation or technology to help with cost control, that allows us as builders or developers to make that shift in the markets as the markets shift around us. So if we need more workforce and affordable housing, it gives us the capacity to do that. Now, I bring up sustainability because as I develop and build and work with our partners in all the markets that we're talking about, it's incredibly interesting how we care about the roadways when we're developing, but we don't take into consideration the defective grids that exist all around us, whether it's Pittsburgh, New York, Chicago, they're all defective. And so we have to keep our focus on making sure that we're grid supportive. That means whether we're offering, whether we're operating off grid or we're supporting that grid with our developments, we create an infrastructure that isn't straining the grid further. So I know roadways are important, but you really have to start thinking more consciously. And I think those are good investments. And then I think they're solid for the next forever. And wellness, because of COVID, it brought us to light on how a lot of the current builds in the marketplace just aren't healthy. Traditional drywall and things like that are just materials that breed mold and allergies and things like that. And we have to start thinking about the people that are living or existing in any of these builds that we do. So I think those are 3 things related to the builds that you're doing in the communities that are super important.
Okay, thanks for that. Etan, what do you anticipate for the coming year?
Last year, we saw around 1,500 regulation CF offerings as an industry. I think we're going to pretty soon see. I wouldn't be surprised if we saw that like literally 1,500 a month. I think it's just an awareness issue, and we're doing. We're working hard to spread that awareness more throughout the country. 30 million private companies in the U.S., many of whom have a need for up to 5 million of equity or debt. So I think we're going to see more players in the game, which is going to be interesting and healthy. At the same time, moving over to the Reg A side, we're seeing an increase in sophistication of issuers utilizing that exemption, meaning that they're creating kind of consolidated fund type structures through Reg A and coordinating market making and alternative trading. Right. So really bridging that gap between the production of private alternative investments with the potential for those types of yield with an insatiable appetite amongst RIAs and managed accounts that have an interest in participating in that yield. The question is how. And so that's really what we're focused on. I think we're going to see some movement there. The other thing is continued fractionalization. Some people call it tokenization. However, there are unique benefits to tokenization as well. doesn't have to include cryptocurrency. It doesn't have to include. It could include blockchain to an extent, depending on the exemption. But I think we're going to see continued growth towards fractionalization, tokenization, and the inclusion of blockchain technology over the upcoming years as well, coming out of this winter that I think the industry has experienced.
Okay, that's interesting. I like that. So I'm going to try and flip through the questions here and give you guys a chance to answer a couple of them. I think some of them have already been answered, but somebody's asking about, can I test the waters without forming a corporation first? I would say that no platform will want to list a partnership or an LLC, a offering, unless you have some sort of corporate structure first. It just makes sense for testing the waters, which is regulated by the SEC. You guys can correct me if I'm wrong.
Oddly, I
So-
think you can say more on a test the waters than you can on a live Reg CF offering, but I would ask an attorney before I
Yes,
venture
agree.
to say that's possible. Yeah.
Yeah, I agree. That's a good point. Here's one. What yields can an investor expect as a coupon on real estate regulated investment offerings? As I've seen 6 to 8%, but how can there be such wide investment coupons? Eitan, you want to jump on that really quickly?
First of all, you also have to expect zero going into this, right? So it's not like it's not like you're putting your money in a bank and you're just getting money automatically. There's risk. But you know, the models we're seeing amongst the private REITs, the yield-based issuers, mostly in the real estate space, tend to range between 5 and 12%. So it's actually bigger than that. Now the 5% isn't necessarily as attractive in this interest rate environment. So let's call it 6 to 12% is probably kind of what is there right now, depending on the term, depending on the structure, and many other factors. But that's what we're seeing.
Okay. This one's for Brian. This person says Ground Floor has been pretty responsible, but also aggressive in attracting both investors and clients looking to secure quick capital for various projects, and how easy it is. On the investor side, they offer really attractive interest rates as well as other incentives and bonuses. Is there any concern about sustainability, Brian?
I understand the nature of the question, and I would just point to our track record. You know, we disclose our financials every year, just like a public company would, actually twice a year, consistent with the regulations. We are 30% owned by our customers, so we're not some venture capital backed hype Silicon Valley, you know, sort of. And those, by the way, I have friends who run those types of companies. They're perfectly fine companies and they're perfectly fine people, but we built our company a different way. And we think that's a real strength. We have managed the company in a very disciplined way over 10 years. Our track record speaks for itself. Our level of disclosure speaks for itself. And yes, when we are looking to grow and capital is plentiful, we, like any business, share the return on that investment by offering bonuses. In a season where, you know, like right now, we've chosen as a company to emphasize profitability over growth. And that's a trade-off, because if you want to grow, you have to invest working capital in your business. That's just true in any business. You have to invest in advertising and in, in staffing and product development, all these things. And we're still doing that because we have enough profitability as a company to continue doing those things. So in a market where a lot of our peers are shrinking, we're actually, growing 30 to 40% this year, which we're proud of. Now, it's not the 100% that we grew last year, but again, it's a different season. And I think every investor, if you're considering it, owning shares of Ground Floor, or you're considering participating in the platform, you have to judge for yourself whether you think I'm credible as a CEO and whether our management team is credible. And I would just point you to our track record and disclosures to help you make those decisions. And there's a lot of information on our blog too, about the investments in particular. So I appreciate the question, and thanks for the compliments.
Yeah, Eve, I'm going to give this one to you really quickly. Somebody asked for some clarification on TTW, testing the waters. I think you guys do it. Can you explain that for the wider audience, what that is exactly?
I'm sorry, what's the question? I lost you at the end.
Testing the waters. Can you explain that? I think you guys do that.
Okay, testing the waters permits you to show investors what you're planning to raise money for. And in order to use testing the waters, you have to, when you register your offering with the SEC, actually attach any marketing materials that you send out during the test the water periods. So you've got to be organized and careful. If you do, 1,000 different things, you've got to attach them all to your registration, which is a real pain in the neck. So let's say you put up a web page ahead of time. You're permitted to do a certain number of things, to gather names of people, to I think gather some information about how much they might invest, but you have to very clearly tell them, this is not the investment opportunity. We'll let you know when the investment opportunity is open. I can see Ethan is nodding. Are you approving?
Yeah, no, I think you got it. No, you got it.
So
It allows issuers to kind of go literally test the waters, go out to their own community and beyond, and say, we're working on something like this with the right disclaimers and disclosures, of course.
Right. So I feel like the problem with it is that, and I don't have a lot of experience with it, is it's almost like, a Facebook event where everyone says, yes, they're going to go just to be nice to you. And so Test the Waters, we had our own Test the Waters, and we had a lot of people sign up and then they didn't invest. So I think the jury's out on the value of Test the Waters, and it's extra work that you really have to do ahead of the offering. So it can be, I don't know. What do you think, Eden?
If you have your own audience, right, of customers, fans, followers, and it doesn't cost you anything, I think it's very helpful, because they're going to give you some information that might be helpful for you to use, or some confidence that yeah, they would be interested in taking a look at this. Maybe they'll give you more information about, kind of what their preference would be, or how much they would, what their budget is for something like this. So I think that's helpful. The question is does it make sense to put together a marketing budget for Test the Waters? And there's two sides to that. One is, do you expect me to give you any indication or information for me if it's not a real offering? I'm going to go back to browsing on Facebook, where, but there's more sophisticated ways that are being developed that issuers are utilizing testing the waters through all kinds of stuff like heat maps and pixels, and it's getting pretty interesting. So there are some new cutting edge ways that I'm seeing being utilized by marketing companies that seem to be pretty interesting now for Test the Waters.
Yeah, and I think that's awesome perspective from all of you, and so thank you for that. I actually have some opinions on TTW too, but we don't have any time for me to share that wisdom right now, because we've gone way past our dedicated time. So I could keep talking about this, because I think it's a very interesting discussion. I think real estate presents a lot of opportunity that's lower risk than early stage, and I think any young or older investor should consider real estate as part of your portfolio. I just think it makes a lot of sense. And you don't just have to go to your brokerage and buy a REIT, because I have different opinions on that too. So first, I want to thank everybody who attended today. I want to thank our panelists. You guys did an awesome job. And I look forward to our next webinar in July, and we're working on that right now, but I think we're going to have some really cool discussions going forward on online investing and the democratization of access to capital and access to investment opportunity. So thank you everybody today, and we look forward to seeing you again. Thank you, Eve, Brian, Dean, Etan. We'll talk soon.
Thank you.
Good to see you guys. Thanks.
Great day.